Back in 2012, most of the money invested in the US, like around 78%, went into what's called actively managed funds. But fast forward to 2022 and the number dropped to 54%. It is a clear trend where people are losing interest in actively managed funds. And it makes a lot of people think, will active investing be dead? And should an average investor be an active investor or just go with passive index? These are two separate questions and I will address them both in this video by diving into the trends of the past few decades. My name is Kanak and welcome back to my channel. Your support is what keeps this channel running. And if you find this video helpful, then show your support by liking and subscribing to the channel. Before we talk about the role of active investors in the stock market, let us understand the root cause why active investors don't beat the market. Back in 1970, Nobel laureate economist Eugene Fama came up with a theory called the efficient market hypothesis. Basically, the theory just means that stock prices you see reflect the stock's actual worth based on all the available information. And according to this theory, people who try to trade stocks by using public information won't be able to beat the market because the prices already account for everything. This idea is a big reason why active investors, which means people who are actively trying to pick and choose stocks, often don't do better than just investing in the index. Even though most of the active investors do not consistently outperform the index over the long term, they play a super critical role in keeping the stock market efficient. They use the available information to make trades, which ensures the stock prices reflect the actual worth of the underlying business. But imagine a hypothetical world where every market participant just decides to be a passive index investor. The market will become highly inefficient. A lot of stock market indexes like the S&P 500 weigh stocks based on the market capitalization. And if everyone just went passive, all the stock prices will only go up in the same direction and with the same velocity, and there will be no relative movement of the stock prices. This will disconnect the stock prices from the actual worth of the business and make the market highly inefficient. And when the stock prices won't reflect the true worth of the business, there will be tons of opportunities for someone to become an active investor and make lots of money. So as soon as excessive passive investing will make the market inefficient, active investors will jump in to seize the profitable opportunity and in turn will make the market efficient again. Now the second biggest reason active investing will never be dead is because not all stock market participants think alike. If someone is selling a stock, there is always a buyer on the other end thinking exactly opposite. Throughout history, there has never been a time when everyone in the market is thinking exactly the same. Considering the stock market's long history and how people think, it is unlikely that everyone will suddenly start thinking exactly in the same way. Sure, there might be times when a bunch of people get excited about one investing idea, creating some inefficiencies in the market. But every time that has happened before, there has been a correction, like the late 1990s. When everyone was crazy about the tech stocks. Prices got out of control, but then active investors stepped in, saw the problem and fixed it. The same thing will happen in the future. When passive investing dominates the market, active investors will jump in, take advantage of the opportunity and make things efficient again. So I think the performance of active and passive investing will go in cycles. When passive investing will become too dominant, it will create opportunities for active investors and they will end up outperforming the passive index. This cyclical movement between active and passive has happened in the past. And as you can see on the chart, from 96 to 2000, passive was on the top. But then from 2001 to 2010, active took the lead. The cycle flipped again from 2011 to 2022 with passive winning. It's like a seesaw. One goes up and the other comes down. And it keeps going. Now let's talk about the second question. Should you be an active investor or a passive index investor? Now even though active investors might outperform the index for a certain period of time, history has shown that they lack consistency and outperformance. It's because of reversion to the mean, which basically means that after a period of doing really well, they tend to underperform and fall back to the average. And if you stretch our view to investing over 10 or 20 years, there aren't many active funds that outperform passive index. It is pretty rare for a fund manager to keep beating the market consistently for such a long time. So for most regular investors, it is usually a good idea to put the majority of their money into passive index funds. Whether you go for a passive index or actively invest is a personal choice. But looking at history, it seems like over a really long stretch, like a decade or two, passive index investing has a pretty good chance of doing better than active investing. So let me now summarize the key points. Active investors and traders are super important to keep the market efficient. It is pretty unlikely that everyone will think the same way and just go for passive index investing. However, there might be times when passive investing will dominate and create inefficiencies in the market, but active investors will step in and make the market efficient again. Just like in the past, the performance of active funds and passive indexes will oscillate in cycles, and it is unlikely for an active fund to consistently beat the market over 10 or 20 years. So despite how crucial active investors are, most regular folks will do better by putting most of their money into passive index funds.